That if you look at the US unemployment rate, it's an incredibly mean reverting series. It's like going up or going down. Just look at a chart. And when it gets down to very low levels, typically it doesn't stay there for very long. You can sort of have episodes where the unemployment rate sort of putters around at very low levels for like a year or two, but usually it starts rising. And I think that probably will happen.
I'm seeing a bunch of very dramatic headlines in the media, on social media, on the internet, and please, help us clarify if some of these things are true or false. The first one, China's economy is collapsing. True or false?
False.
Is the U.S. economy finally showing cracks in the labor market and slowdown in growth? New data confirming that the world's largest economy is cooling has given the U.S. Federal Reserve room to hold interest rates steady, economists say, even as it leaves open the possibility of resuming a historic monetary tightening campaign later in the year. Friday's U.S. jobs report, which showed the unemployment rate ticked up in August, while a healthy 187,000 jobs were added, marked the latest evidence this week that the economy, while still resilient, is beginning to cool as consumers and businesses confront higher borrowing costs. The new data comes just 3 weeks ahead of a crucial Fed policy meeting when Chair Jay Powell and officials will decide whether they have squeezed the economy sufficiently to bring historically high inflation back under control, after raising the benchmark interest rate to a 22-year high. The Fed is widely expected to waive an interest rate increase at the September gathering, leaving the federal funds rate between 5.25% to 5.5%. Now, I've chosen the Financial Times for this particular story because they've been a leading source of business news for me for the last 10 years. Their coverage of breaking economic data has been instrumental in helping me prepare and gather information for my own shows. While they're renowned for their business news, the FT's coverage encompasses a lot more than that, ranging from op-eds, lifestyle and arts, climate issues, technology, and careers. Their award-winning team consists of 700 journalists worldwide, and their in-depth analytics tools covering all asset classes as well as M&A, trading, and investing are used by over 300,000 global finance professionals. Now, with $1, you can gain a monthly trial subscription that gives you access to their suite of products, so make sure to click on the link down below to learn more. Now let's learn from an expert about how to invest while the economy is slowing down and what the Federal Reserve may do next. Peter Berezin returns to the show. He is the Chief Global Strategist and Director of Research at BCA Research. And prior to BCA, he was the Chief Economist at Goldman Sachs and has served as an economist with the IMF. Peter, welcome back. Always good to have you.
Good to be back.
You and your firm has made a number of very good calls this year, calling for U.S. equities to rise higher and, generally speaking, the strength of the economy in the U.S. to persist. We're going to be talking about things outside of the U.S. a little bit today and things that potentially may worry investors abroad. And I'm talking about, in particular, China, the world's second largest economy. Let me just start with a few true or false statements. So just please answer true or false, and then provide an explanation as to why you picked that answer. I'm seeing a bunch of very dramatic headlines in the media, on social media, on the internet, and please, help us clarify if some of these things are true or false. The first one, China's economy is collapsing. True or false?
False. I mean, it's still growing, right? Growth isn't strong. It's probably below trend, but it's not experiencing a collapse in any sense of the word.
Okay. China is an investment theme for investors, won't be as dominant this decade as it was maybe in the early 2000s or 2010s.
Well, there's a debate about whether China is investable or not. I think China is investable, but just because something is investable doesn't mean you should invest in it. I think right now China is facing a number of problems, and I think investors are probably better off just waiting on the sidelines to see whether those problems are addressed in a strong enough way. Right now, it's not clear.
Okay. True or false, the Evergrande collapse will have ripple effects throughout the world?
False. And China's financial system is very much closed. There's almost no exposure to Evergrande, or for that matter, Chinese banks outside of China. So we're not going to have the same sort of spillovers that the subprime crisis in the US caused to the rest of the world.
All right. Deflation in China. True or false? It will spill over or be imported into the U.S. and cause deflation here.
True, but that might not be such a bad thing. U.S. inflation is coming down, but it's still uncomfortably high. If China is exporting deflation to the rest of the world, that's not the worst thing imaginable. In fact, it's a bit like what happened in the late 1990s when emerging markets were suffering. They were creating this deflationary shock, and if the Nasdaq was going parabolic because that deflationary impulse was allowing the Fed to keep monetary policy looser than it would have been otherwise.
Okay, so let's talk a little bit about the structural problems that China is facing. Actually, before we do that, can you provide an explanation as to why the central bank recently cut rates? From what I understand, it was more or less an unexpected move.
Well, I mean, China's economy is feeling the impact of two major shocks. One, the export market in China is suffering because people, after having splurged on goods during the pandemic, are buying more services. And that's being compounded by the fact that a lot of activity that used to take place in China is being relocated to other emerging markets in the case of kind of low value added manufacturing and back to the US for higher end manufacturing. So you got that problem. And then you got the other problem around the housing market, which is likely to be a huge problem for the next few decades. And the central bank is responding to that by cutting rates, trying to stimulate spending at a time when exports and housing are subtracting from spending.
Right. And do you think that rate cut from the Chinese central bank will have any impact on the Federal Reserve's decision on monetary policy for the rest of the year?
No, I think that's probably not going to influence the Fed's thinking very, very, very much. The question is whether it actually helps China. And in and of itself, it's not going to matter. But what we've seen out of China over the last month or two has been kind of this steady trickle of measures, both on the fiscal side and on the monetary side. And taken together, they don't amount to a huge source of support, but increasingly it's becoming meaningful.
Okay. I'll just read you two paragraphs of this article. New data out Tuesday showed China's service sector activity hit an 8-month low in August. You briefly touched on that earlier. The slowdown in the world's second largest economy could become a headwind for what has been otherwise a resilient U.S. economy, according to economists at Ernst & Young. While there is growing optimism about a soft landing for the U.S. economy, global challenges still cloud the horizon, with China's economic turmoil emerging as a top risk, said EY chief economist Greg Dacko and EY senior economist Lydia Boissois. Now, can you tell us what the relationship is directly between China's economy and U.S. Economic resilience?
It's not a huge relationship, to be honest. I mean, U.S. exports to China as a share of U.S. GDP are tiny. I think I don't know the exact number. It's around 1% of GDP, a little bit less than 1% of GDP. So the fact that China is importing less doesn't really affect the U.S. very much. In fact, you could kind of argue the opposite. The fact that foreign direct investment into Chinese manufacturing has weakened considerably over the last couple of years. A lot of that investment is just going back into the U.S. So if you look at U.S. manufacturing construction, it's booming. It's up like 70% year over year. Not all of that is manufacturing that's being relocated from China to the U.S., but some of it is. So arguably, the weakness in China is not really hurting the U.S. at all. Now, obviously, if things get really bad there, that could change. But right now, I would say it's sort of a benign shock.
What about the shadow banking sector in China that's more or less plagued the country for more than a decade? Is that of concern to you? Is that tipping over?
I think that's a big concern for China because the Chinese banks have actually tried to avoid a lot of lending into the property market, especially with respect to the property developers. So that hole has sort of been filled by the shadow banking system. Uh, those shadow financial institutions have been issuing these wealth management products, and that financing has gone into the property market. But now that property developers are on the ropes, it's not clear whether those loans can be paid back. And so a lot of Chinese households that own these wealth management products are understandably very, very nervous. And we'll see what the government does. The government could very well bail everybody out, but that is definitely a concern.
The Thucydides Trap refers to the phenomenon in which one emerging superpower could challenge an existing superpower. This has been posited by some historians and political scientists. Do you think that that's what's happening right now, that eventually a conflict between China and the U.S. is somewhat inevitable?
I don't think it's inevitable, but it is definitely a risk. And we're not living in a world anymore where there's a single political hegemon, the US. Now there are competing spheres of influence. And historically, when there have been competing spheres of influence, that has led to a more frosty backdrop for global trade and finance. And I think we're seeing that now, but it's not inevitable that things will continue to deteriorate. I think right now the fact that China seems to be supporting, at least in the minds of a lot of Western observers, Russia is creating problems with Europe and the U.S. But who knows how that will evolve? It's hard to say right now whether this relationship will continue to worsen.
Okay. The RMB has weakened in light of weaker Chinese exports, so it edged down 0.1% to 7.32 per dollar on Thursday, as we speak today on Thursday. This raises concern that the central bank is going to set a lower trading band. Does this have any impact on the dollar per se?
It does. I mean, the dollar has started to strengthen, and it's understandable why. We just talked about how the PBOC is cutting rates, easing monetary policy, whereas the U.S. has been tightening monetary policies. So if one central bank tightens, another one loosens. Typically, the currency of the country where the loosening is taking place goes down in value, and that's what's happened. The Chinese yuan has weakened. I don't think it'll continue to weaken. It's not a very expensive currency, and China still has a large current account surplus, a lot of foreign exchange reserves, but probably the path of least resistance in the near term is for further weakness in the Chinese currency.
Down the line, and perhaps never going to happen, but do you see any evidence or reason for the Chinese to eventually abandon the managed float or the soft peg to the dollar and have a completely free-floating currency? Is that in the cards?
No time soon. I think China likes the fact that it manages its currency in their minds. It gives some stability to the economy. We've seen in the past cases where even a small depreciation in the currency has led to a wave of capital outflows. So China most likely will manage the currency just as they'll manage the capital account. Now, perhaps over time, they'll loosen things up. They do, after all, want to have a reserve currency, and you can't have a reserve currency if it's actively managed. But I think that is well into the future. For now, the U.S. dollar remains the only game in town when it comes to global reserve currencies.
So an interesting tech development out of China is that Huawei recently announced the Mate 60 Pro phone, and it uses, interestingly, a semiconductor chip made by a Chinese manufacturer, SMIC. Now, what's interesting here is that, without getting too much into the technical details, the chip is called the Kirin 9000 chip, and it uses a 7 nanometer process to fabricate the chipset, which is just slightly larger than the ones made by TSMC. TSMC, as you know, is the world's dominant chip manufacturer based in Taiwan. They make chips for basically all the major devices, all the iPhones, laptops, computers, so on and so forth. Now, the Chinese have been developing their own chip technology. Part of the reason for the sanctions, I believe, was to keep the Chinese away from developing this technology to the same level of perfection as TSMC. And now it seems like they're getting close. So does that mean that sanctions might be over because they're just no longer necessary?
I don't think it means the end of sanctions anytime soon, but it does show that China has ways to get around those sanctions, in particular in this case by developing its own technology domestically. And the thing is, China does have the resources to do this. You have a lot of graduating students. China, the youth unemployment rate before they stopped publishing it was over 20%. And a lot of those students are like graduating with degrees in engineering and physics. So the government, is trying to build out these technologies, and I think they're probably going to be largely successful in doing so.
Does that then change the dynamics of the Taiwan and U.S. relationship? Because again, part of the reason that I've heard is for protecting Taiwan from the U.S. perspective is to keep China away from their fabs, the factories producing the semiconductors. If China has their own, then Taiwan's strategic importance to the world becomes, I guess, slightly diminished, right?
Yeah, and actually that could be kind of a silver lining that if you can develop your semiconductor technologies yourself, and then you don't need Taiwan as much. So I mean, I'm not a geopolitical strategist. I don't know what's going to happen between those two economies, but certainly these risks are there, and I think they're relevant for investors.
Okay. All right. So let's turn back to U.S. and global growth. How would you evaluate U.S. Economic strength overall relative to its peers in the G7 countries and perhaps in emerging markets right now?
Well, the U.S. has definitely been outpacing other major economies. I think that's partly because the US economy isn't as exposed to the global manufacturing cycle as Europe or China. And of course, as I mentioned, right now we are kind of in this air pocket of demand for manufactured goods after people bought so many electronic goods during the pandemic. Things have really softened down. The US is just better poised to weather that. The other thing that's kind of helping the US is that it doesn't really have any major imbalances to contend with. So if you look at the housing market, the homeowner vacancy rate is at a record low. The US has not been building enough homes for 15 years. So we don't have this big glut of homes that we had like in 2007. CapEx spending has been very, very weak. There's no overhang of capital spending like there was in 2000. The banking sector obviously has its problems, especially amongst the regional banks. But in general, US banks are well capitalized. The quality of the lending, especially into the mortgage market, has been very strong for the last decade. That's also giving the US quite a bit of resilience.
Overall, now you were talking about 2 months ago. You were talking about how the strength of the U.S. economy has persisted. Since then, the unemployment rate has slightly ticked up to 3.8%. The last payrolls numbers added 187,000 jobs, which I believe was slightly below consensus estimates. Is the labor market showing signs of weakening right now?
That's not really. I mean, yes, unemployment did tick higher, but that was because of an increase in labor force participation. More people joined the labor market. They're looking for work. The amount of employment, the number of people working, still went up last month. And if you look at like initial unemployment claims, they've actually been coming down on a seasonally adjusted basis. Now, there's some questions about the seasonal adjustments, but even if you look at non-seasonally adjusted initial claims, they're running only slightly higher than they were this time last year. So right now, the leading indicators for the labor market still look pretty healthy. And that could change, and often things change pretty quickly. But I don't think there's really any evidence to suggest that the labor market is going to crack anytime soon or that a recession is imminent.
Okay. I'd like to play you a clip of President Biden making a remark about the labor market.
This morning, we learned that the economy created 190,000 jobs last month. All told, we've added 13.5 million jobs since I took office. Around 800,000 of them manufacturing jobs. We created more jobs in 2 years than any president ever created in a single four-year term. We did it in 2 years. What's more, when I took office, the unemployment rate was 6.3%. The nonpartisan Congressional Budget Office predicted that it would not get below 4% until the end of 2025. Now, the unemployment rate has been below 14% for the last 19 months, the longest stretch in over 50 years. We've recovered all the jobs lost during the pandemic. We've added 1 million more new jobs. More than 700,000 people joined the labor force last month, which means the highest share of working-age Americans are in the workforce now than at any time in the past 20 years.
Is that true, first of all, that we've added back all the jobs lost during the pandemic, and second, that the labor market is probably at the strongest point in the last 20 years?
Yeah, I mean, the labor market has been very strong. The number of jobs has risen. If you look at prime age labor force participation, that is to say, the share of the working age population between the ages of 25 to 54 who are now working or looking for work, that has surpassed its 2019 high. So no one will kind of quarrel with that, but there is sort of a downside here, which is that if you look at the US unemployment rate, it's an incredibly mean reverting series. It's like going up or going down. Just look at a chart. And when it gets down to very low levels, typically it doesn't stay there for very long. You can sort of have episodes where the unemployment rate sort of putters around at very low levels for like a year or two, but usually it starts rising. And I think that probably will happen next year. And the reason it's kind of hard to keep unemployment low is because once you're at full employment, you get into a bit of a trap. Anything that kind of boosts spending, causes growth to accelerate above trend, will then stoke inflation, and the Fed will have to react by raising rates. Anything that kind of lowers spending so growth is below trend will start to push up unemployment, and that'll feed on itself. So in practice, staying at full employment for a long time is hard. And that kind of tells me that a recession most likely will happen. We've been saying 2024 for a couple of years now. So we're really out of consensus early last year when people were saying that a recession is imminent. But we still have that 2024 recession call. We think there will be a recession next year. And from a kind of markets perspective, as the consensus has moved towards us, we've sort of become a little bit more cautious on markets. We're not bearish yet, but we are moving in that direction.
Actually, I don't think you're too out of consensus anymore. I think a lot of people have started to shift their own view more in line with yours, pushing back the recession call for next year. This came in from Nathan Sheets, chief economist at Citibank, for example. He said that the services demand continue largely unabated. The labor market has stayed strong. Wages have continued to rise. Some of the weakness anticipated for this year is being pushed into 2024. If the economic data right now is still strong, why would there need to be a recession next year? Why couldn't it just be averted altogether?
Well, because there are lags in monetary policy. So bank lending standards have been tightening now for some time, but that typically only impacts the economy with a lag of like a year or so. So the full effect of tighter bank lending standards has yet to be felt. A lot of people refinanced their mortgages during the pandemic, and so average mortgage rates have remained quite low. But as people buy new homes, they're going to be saddled with higher rate mortgages. That means less discretionary spending on their part. So that could be the source of a recession. It is, however, possible that demand remains not just resilient, but so resilient that unemployment starts to fall. And if that would happen, we could get a second wave of inflation. That's sort of the point that I was getting to earlier, that when you're at full employment, you need monetary policy to be almost perfectly calibrated to avoid recession. And in practice, given the lags in monetary policy, given uncertainty as to where the neutral rate of interest is, it's very difficult to calibrate monetary policy so well.
You mentioned that there could be another wave of inflation. What is that coming from? Is that coming from demand? Is that coming from higher energy prices? We saw oil spike up this summer. What is the source of this?
Well, oil could contribute to it, but I think the bigger issue would be around the labor market. So we were just discussing how people are coming back into the labor market, and they have been. And that increase in labor supply has allowed firms to hire a lot more workers than they would have otherwise. But at this point, there's not much scope for labor supply to rise further, which means that unless labor demand starts to really soften, those job openings that have been coming down could start to go up again, and that could lead to upward pressure on wages in a second wave of inflation. So the irony has been that as inflation has fallen since last year, that has pushed up real wages. And when real wages go up, people typically spend more. And that in turn means that falling inflation can often sow the seeds of its own demise.
Stepping aside here, why do people spend more when they make more? Why doesn't the savings rate go up? Why does that money have to go into spending?
Well, it depends on whether people see their income as going up temporarily or permanently. So if you have kind of a one-off stimulus check and you're not kind of really constrained in your ability to borrow and save, then there's a good chance, especially if you're kind of a richer household, that you just sort of save that money because it's one-off, right? But if your income goes up and you see that as being kind of a permanent increase in income, well, then you got Friedman's permanent income hypothesis that says that a permanent increase in income should lead to a permanent increase in spending. And so to the extent that wages are rising and real wages are rising, that is going to lead to more spending. And it's possible, not inevitable, but it's certainly possible that you get so much more spending that inflation starts to reaccelerate.
I was looking at data from the Federal Reserve last night, and they have a chart showing wealth across all wealth brackets. The bottom 50%, their accumulated wealth has stayed relatively flat, while the top 50%, top 1%, even the top 0.1%, their wealth has been tickling up over the last 6 months. How much was that mainly due to rising market conditions because the wealthy have invested in assets?
Yeah, that's right. So the wealthy holds a very disproportionate share of stocks. So when the stock market goes up, the wealthier households gain more. But what that data probably isn't capturing is that over the last quarter or so, home prices have started to rise again. And that has more of a broad-based impact on overall household wealth. And again, we're just discussing the risks of a second wave of inflation. Given that people are feeling more wealthy, given that given home prices are rising again, that could lead to more spending.
So in light of all this, what is BCA's view on asset allocation right now? I think a few months ago you were overweight U.S. equities. Is that still the case?
So within the equity portfolio, we do favor U.S. stocks over overseas stocks. If one asks what our view is on equities relative to, say, bonds or cash, earlier this year, certainly my service was recommending an overweight to stocks compared to bonds and cash. But right now we're neutral, and we're neutral for some of the reasons that we just discussed. A consensus has moved towards our view of no recession this year. And if the risks of a second wave of inflation were to increase, right now it's not my base case, but I'm giving that about a 25% probability. But if that probability were to go up, then I would have no problems in turning outright bearish on stocks.
So we'll keep an eye out for that. And within the U.S. equity universe, are there particular sectors that you favor right now?
So right now we're in a transition phase. We were very much favoring cyclicals over defensives earlier this year. But again, as we're getting closer to that 2024 recession call, I think it makes sense to pare back exposure to cyclicals and start buying more defensive sectors, such as healthcare, for example, such as utilities and staples.
Do you see a scenario or possibility that during a recession next year, should it come, the Fed may actually provide monetary stimulus, which may throw off a bearish view that may actually push up asset prices? Could that happen?
Oh, there's no doubt that if we have a recession, the Fed will cut rates. The Fed always cuts rates in a recession. The question, again, just goes back to the lags. If the Fed starts cutting rates, the impact of those cuts on broader economic activity probably won't be felt for a year or so. So that will prevent a deep recession, but it won't preclude a recession altogether. We'll probably still have a mild recession next year, and perhaps a not so mild recession. That recession is due to a second wave of inflation that forces the Fed to raise rates to 6 or 7%.
There is a higher probability priced in of rate cuts next year. Should they cut rates, wouldn't that be positive or bullish for stocks?
Well, it depends on why they're cutting rates. If they're cutting rates because the economy is weakening and earnings are falling, then those lower rates provide an offset, a mitigating factor. But ultimately, if you just kind of look at how stocks do during recessions, they always go down. And given the starting point of valuations, it wouldn't be surprising at all if stocks were to fall 20% from current levels in a recession scenario.
Peter, where can we learn more about your work and BCA's work and learn more from your research?
I'll just go to our website, bcaresearch.com, or follow me on Twitter or LinkedIn.
Yeah, you've got a great Twitter feed. Posting a lot of charts. So follow Peter's Twitter. Very informative. Thank you very much for coming on today. Very informative as usual. Appreciate it.
Thank you, David.
And thank you for watching. Don't forget to subscribe and like this video.